1 month ago, a single company made history. It turned one man into the richest human being who has ever lived, the world's very first trillionaire. At his peak, Elon Musk's fortune reached $1.45 trillion, all because of one company, SpaceX. Today, that number looks very different. And the story of how it slipped away says a lot about how fragile even the biggest fortunes on Earth really are, no matter how solid they look on paper. To understand what happened, we need to go back further than you might think, not just a few weeks, but more than 2 decades. SpaceX was founded in 2002, at a time when almost nobody believed a private company could compete with national space programs. Its first 3 rocket launches failed. A 4th failure would have likely ended the company for good. It didn't fail a 4th time. And over the next 20 years, SpaceX pulled off something the entire aerospace industry had written off as science fiction: rockets that land themselves and fly again, instead of burning up after a single use. That 20-year foundation is what made this June possible. SpaceX finally went public, meaning ordinary investors could, for the first time ever, buy a small piece of the company on the stock market. It raised over $86 billion, making it the biggest IPO, the biggest first-day stock sale, in corporate history. By then, SpaceX already had a real, working business behind it. Its satellite internet service, Starlink, beams connectivity down to customers in remote corners of the world who never had reliable internet before. Quick explainer, because it matters for the rest of this story: when we say a company is worth a certain amount, we mean its market value, the share price multiplied by every share that exists. It's not cash sitting in a bank. It's a live estimate that can rise or fall by the hour. That's exactly what happened here. Just before the IPO, SpaceX did something that changed the whole picture. It merged with Elon Musk's other company, xAI, an artificial intelligence lab best known for its chatbot, Grok. That merger, called the xAI deal, meant investors weren't just betting on rockets and satellites anymore. They were betting on Musk's ability to win the AI race too, all inside one company. Starlink alone gives SpaceX something a lot of AI startups don't have: real, paying customers today, not just a promise of profits somewhere down the road. That's part of what made the IPO so appealing in the first place. Like most tech companies, SpaceX also pays a large share of its workforce partly in stock instead of just cash. That's a great deal when shares are soaring, and a much harder one when the price suddenly drops. On the day it listed, the stock jumped 19%. Musk's paper fortune exploded overnight, and just like that, he became the first trillionaire in human history. It felt unstoppable. Early believers who had bought shares privately, long before the public even got the chance, were suddenly sitting on extraordinary paper wealth. But stock markets have a habit of humbling even the biggest stories, and this one didn't take long. Fast forward to this week. SpaceX shares slipped below the very price investors paid on day one, $135 a share. That might not sound dramatic. But when a stock falls back to its starting line after a triumphant debut, it's a signal that excitement is cooling off fast, and it hits some people harder than others. At its highest point, SpaceX was worth $2.6 trillion. Today, that number has fallen to roughly $1.75 trillion, over $800 billion gone in a matter of weeks. And because Musk personally owns about 38% of the company, his own fortune fell right along with it. His net worth today is estimated at $856.8 billion. Still an almost unthinkable amount of money, but no longer enough to hold the title of trillionaire. This actually isn't new territory for Musk. His other company, Tesla, has spent years swinging wildly between record highs and brutal sell-offs. Investors who follow him have learned that huge gains can vanish just as quickly as they arrive. So who actually feels this the most? Early private investors who got in years ago are still sitting on enormous gains, even after this drop. They bought in low, long before the hype began. The people most exposed are newer employees and everyday retail investors who bought shares near the peak, right after the excitement of the listing, the ones with the least cushion if the price keeps sliding. Meanwhile, rivals in the space industry, smaller companies racing to build their own reusable rockets, are watching closely too. Every wobble in SpaceX's stock is a reminder that even the industry leader isn't untouchable. SpaceX also isn't the only massive AI-linked listing this year. It arrived in the middle of a broader wave, with chipmaker SK Hynix and AI lab Anthropic both racing toward the public markets at nearly the same time. That wave has made 2026 one of the biggest years for new stock listings in over a decade. But a crowded field also means investors have more places to put their money and less patience for any single company that stumbles. So what actually pulled SpaceX's stock down this time? It wasn't one single event. It was several worries landing at once. First, SpaceX borrowed heavily to fund its AI ambitions. Last month alone, it took on $25 billion in new debt. That money is going toward building the computing power needed to compete in artificial intelligence, a hugely expensive bet with no guaranteed payoff. And SpaceX isn't alone in borrowing to chase AI. Even its own AI division, xAI, has separately raised billions in bonds and loans just to keep building data centers. Some of that xAI debt is costing an eye-watering 12.5% in annual interest, a rate that tells you exactly how risky lenders think this bet really is. SpaceX is part of a much bigger pattern here. Across the technology industry, companies are expected to spend around $600 billion on AI infrastructure this year alone. To pay for it, tech companies are increasingly turning to the bond market instead of using their own cash, with AI-related borrowing expected to reach roughly $270 billion in 2026, nearly double what it was the year before. That's fueling a bigger debate across the whole industry. Is this AI build-out a genuinely transformative investment, or an expensive bubble that hasn't proven it can pay for itself yet? Nobody agrees on the answer. The optimists argue this is simply what building the future looks like: massive upfront costs today, in exchange for owning the infrastructure that everything runs on tomorrow, the same pattern seen with railroads and the internet before it. The skeptics counter that a lot of this spending is happening faster than the actual profits are showing up, and that debt-fueled bets like this one tend to look brilliant right up until the moment they don't. It's worth remembering why any of this matters beyond Wall Street, too. Starlink already connects people in places regular internet companies never bothered to reach, from remote villages to disaster zones where other networks have gone down. For everyday investors who bought in on day one, the swings are a harder lesson. A company can be genuinely important, and its stock price can still fall sharply, especially in its very first months as a public company. Second, investors are nervously watching the Federal Reserve. If interest rates rise, expensive, richly valued tech stocks like SpaceX tend to fall the hardest, since so much of their value depends on profits that are still years away. And third, timing made things worse. The stock's slide came just one day before SpaceX's next big test, the 13th flight of its Starship rocket. Starship's testing history has been dramatic, to put it mildly. 12 earlier flights produced a mix of stunning successes and fiery, very public failures, live-streamed for the world to watch. A 13th failure, in a moment like this, could shake investor confidence even further. A clean success might calm the nerves, at least for a while. Starship isn't just another rocket, either. It's designed to carry far more cargo than anything SpaceX has flown before, which is exactly why it matters so much to the AI story. Heavier rockets mean more satellites, more ground stations, and more of the physical infrastructure this whole bet depends on. Every test flight, successful or not, gets studied line by engineers looking for the next fix. That's how the earlier failures eventually turned into landings, the same slow, expensive process now playing out again in full public view. Not everyone is worried, though. Most Wall Street analysts still like the stock long-term, about 80% rated a buy. Their average price target sits around $247 a share, well above where it trades today. Their argument is simple: SpaceX isn't just chasing quarterly profits. It's chasing a market it estimates at $28.5 trillion across rockets, satellites, and artificial intelligence combined. That's a market bigger than the entire economy of every country on Earth except the United States and China. And behind all the spreadsheets, there's still the same long-term vision that built the company in the first place: reusable rockets, a global satellite network, and eventually, a foothold on Mars. The question isn't whether that vision is exciting. It's whether SpaceX can keep paying for three enormous bets: rockets, satellites, and AI, all at the same time, without stumbling badly on any one of them. History offers a useful reminder here. When Facebook went public back in 2012, its stock also sank below its own IPO price and stayed there for over a year, written off by plenty of investors as a disappointment. Facebook eventually turned into one of the most valuable companies on the planet anyway. A rough start after an IPO doesn't automatically predict how the story ends, it just means the first chapter was a hard one. Picture the best-case version of this story: Starship keeps flying successfully, Starlink keeps growing its customer base, and xAI's data centers start generating real revenue. In that world, today's dip looks like a tiny blip on a much longer chart. Now picture the other version: interest rates rise, a Starship test fails publicly, and AI spending doesn't pay off as fast as promised. In that world, this month's drop could be the first chapter of a much longer slide. Nobody, not even the analysts with their confident price targets, actually knows which of those two futures is coming. Betting everything on rockets and AI at once is either visionary or dangerously overextended. What we do know is this: becoming the richest person alive took SpaceX one single day. Losing that title back took barely a month. Zoom out far enough, and this story isn't really just about one company or one billionaire's net worth. It's a preview of how the next decade of the economy might actually work: huge, debt-funded bets on space, satellites, and artificial intelligence, all playing out in public, in real time. For everyday investors watching from the sidelines, that means bigger opportunities than ever before and bigger swings to stomach along the way. There's no version of this story where the excitement comes without the risk attached. And that, more than any single number, is the real lesson here: in markets built on future promises, fortunes can be made and unmade faster than most people can even follow.